Valens Research, Uniform Financial Analytics.
RH, or restoration hardware. For those of you who have not been in an absolutely absurd restoration hardware store, restoration hardware, right, obviously they make furniture and other things for you to basically fill up your home from a premium perspective. And they really position themselves as really a lifestyle brand. And so what you're looking at here is all of a sudden you can see the power of that, right? Just really quickly to jump in, this chart, which is where every single time we come to look at a company in the uniform accounting framework and in the Valens Research app, this is always where we start people, and there's a reason for it, because it is such a great, powerful summary of what's going on. It's what we call the PVP chart, or the Performance and Valuation Prime chart. Again, like I said, we're very literal here at Valens. Why is it called that? Because we look at performance, returns, and asset growth, and valuations relative to assets and relative to earnings. And because we look at them on a uniform accounting basis, we call it prime. Prime meaning adjusted or cleaned up. Right? So what you can see here is, first and foremost, when we're looking at return on assets, these orange bars here are the orange distorted as reported ROAs for restoration hardware over the last 8 years. What you can see is restoration hardware did have hard times from 2017 to 2018, but then they recovered, and oh great, now ROAs are back up to where they were in 2014, 2015. This looks good, but it says really restoration hardware is what it is, and we're at the high end of a cycle for restoration hardware. And because of that, that means that we could see a rollover. But the reality is, when we clean up the accounting and remove the noise for restoration hardware, we can see restoration hardware has actually transformed its business in the last 4 years. It doesn't have ROAs that are back at where they were in 2014. No, ROAs that were 10% in 2014 or 9% on an as reported basis are actually 18% right now. They have almost doubled their profitability. And so when you look at the company and you think about it from that context, you're having a completely different conversation when you're analyzing this company, because all of a sudden you're saying, oh, wait, so what does this mean? Does that mean that this company actually is now a new business and I have to think about their cycle of their earnings, of their competitive profile, et cetera, in a different way? And you do, because you have to understand what changed from here to here, right? To be able to understand what really is going on with the business, because it's not the same business. And that means how you model it in the future is going to be different. Similarly, we look at asset growth, and right in asset growth, we look the same way. We look at what is the distorted as reported asset growth, and then the true uniform accounting asset growth of the company. And what you can see here is what's so powerful is all of a sudden, right, we've got a company that in reality has an asset growth that wasn't massively high in 2019. It was actually relatively neutral. The company isn't reinvesting as quickly as the as reported metrics highlight to us. But the really powerful thing that we can do here is when we look at these two charts together can give us a really simple heuristic for free cash flow. Right? Because if you think about it, this is like the operating cash flow of the business. If the company had $100 of assets, it'd be throwing off $18 in operating cash flow. This is the reinvestment, if you will, the cash flows from investment for the company. So for restoration hardware, it's throwing off $18 and it's reinvesting $3. So the free cash flow of the business is around $15, right, for every $100 of assets the company has. So when we look at that, all of a sudden we can think about it in a different way. And it's also really powerful because it can help us understand when we have negative free cash flow companies, like an Amazon, right, which could be negative free cash flow for 20 years, but have massively high ROAs, right? You want to reinvest in a high growth, negative free cash flow company that has high returns, because that means that they just have a good business, that they're growing really fast. But you can't understand that if you just focus on metrics like free cash flow without this context. Right? We can also look at valuations to understand not just how good is a company, but what is the market pricing it to do. And right, you can already see here where you see how volatile these orange bars are for the as reported price to book equity. The problem with price to book equity on a traditional basis is it has so much noise, it's basically useless, right? You try to have a relationship between price to book equity and return on equity, say, and there's so much garbage in, garbage out because the as reported accounting, you can't see it. What we do is we look at a uniform accounting adjusted price to asset metric. What we find is there's a very strong relationship between this and the returns the market expects a company to have. so we can have a better understanding of what market expectations are from a valuation perspective. Similarly, we can look at a uniform accounting adjusted PE metric, right? And understand from a PE basis, what is it the market's pricing the company to do? How expensive or cheap is it relative to itself historically and relative to its peers? What we can see here is for Restoration Hardware, valuation skyrocketed this year relative to the prior years for the company. And we can also see just the context of right, where valuations coming and going. And the last chart we have here, right, is TSR-R, total shareholder return relative to the market. Right? TSR, for those of you who don't know, total shareholder return means what is the company's total return to investors in terms of a combination of stock appreciation and dividend income. And we look at it with the little tiny r relative to the market because we don't just want to understand how the stock performed, but did the stock outperform or underperform the market? And what we can see here is, right, when this line is flat, that means the stock performed in line with the market. When it's positive, that means the stock outperformed the market. When it's negative, the stock underperformed the market. And what we can see is there is such a powerfully strong relationship between TSR relative to the market and uniform accounting data for a company, time after time after time, that doesn't exist when we look at the as-reported accounting metrics, right? Look at this. If this company wasn't really growing that much, and had ROA return back to historic levels, well, we shouldn't see TSR take off like it has. TSR should just be back to where it was in 2015. In reality, it's taken off because uniform accounting is what the market's paying attention to. The market knows that it actually has had returns expand to new all-time high levels and the business has changed and the market's paying up for that, which is why the TSR has outperformed. And that brings us to the most important part of this chart in totality, which is these 5 bars here and these 5 bars here, right? This is all history. This is all what has the company done. These bars are about what analysts and the market expect the company to do. The light blue bars are what Wall Street analysts are forecasting Restoration Hardware to do for the next 2 years, right? Wall Street analysts are basically saying this company has had returns improve from 10% to 18%. I think it can do the exact same thing again over the next 2 years. Then what these white bars are what the market is pricing the company to do at a $9 billion valuation and a $460 stock price. The market is pricing this company for returns to stay flat in the future. The market is basically saying you are not a retailer, you are a lifestyle business and a subscription business. And because of that, your returns can be high and resilient. Now, you can agree with that or disagree with that. I think that our view would be expecting any retailer to have returns that are this high for a sustainable period of time, basically into perpetuity, is probably too aggressive. And so if we think that, what we can do is we can really quickly do scenario analysis using what we call the embedded expectation tool. Right now, we're solving for what the market's currently pricing the company to do, right? We're solving for $460, which is what the market is pricing right now. But what we can also do is, let's say we want to do our own scenario analysis. We can say, yeah, but you know what? We think that it's going to be growing slower like it has the last few years. And we think that returns probably after peaking massively in the next 2 years because of the at-home revolution, they'll probably come back down. And let's just say we think they're going to be at 15%. Well, we can solve for what the stock price would be in that scenario. And we can say, right, Restoration Hardware is overvalued if you think this is the case. If you think this is the case, the stock is worth basically 80% less than what the market's pricing it to do. Now, I'm not saying this is the right thing, and we're not recommending everyone short Restoration Hardware, but this is the type of quick scenario analysis you can do to say, hey, even if I like Restoration Hardware, unless I think Restoration Hardware can beat having a 30% ROA and 5% growth for the next 5 years, which they've never done in the past, I don't know that I can really recommend the name. And that's a quick type of analysis that you can do. But again, one, fast, so you to be able to quickly talk to your analyst team or your PMs or your entire team about what you're thinking about a company without having to build a whole entire model. But also, it's going to change the way that you talk about the company because you're not going to talk about this as a staid retailer. You're going to want to have a conversation about what's going on in the business. And that's what's so powerful, how uniform accounting changes your conversation and focuses your conversation more into the world of companies and reality as opposed to all the noise.
Valens Research, the world's leading source for uniform financial analytics.